Many experts are screaming from the rooftops that silver is the most undervalued asset in history. They say you should go all in immediately before the explosion happens. But what if I told you that this undervaluation has actually been a sophisticated trap, one that has held investor capital hostage for over a decade? Think about it. If something is truly cheap for 10 years straight, is it a discount, or is there a fundamental flaw in the system that we are simply choosing to ignore? Welcome back. Today, we are diving deep into a recent viral perspective from expert Chris Galizio. He claims we are living in an Orwellian financial society where the ecosystem of capitalism is fundamentally broken. He points to the death of the dollar and the inevitable rise of hard assets like silver. It's a compelling case, and on the surface, the numbers look undeniable. The debt clocks are ticking, and the gold-to-silver ratio is screaming buy. But here's the problem. Most people watching these videos only see the explosion and miss the liability. In this video, we aren't just going to echo the hype. We are going to perform a surgical dissection of the facts. We'll explore why the machines have taken over the market, why cheap doesn't always mean profit, and the one specific tipping point you need to watch before moving a single dollar. Are you holding a crystal ball, or are you just falling for the oldest FOMO trap in the book? Let's find out. To understand why silver is supposedly so cheap, we first need to look at the evidence experts are presenting, a financial system now operated by machines rather than humans. Think about the last time you looked at a stock chart. You probably saw a clean, jagged line moving up or down based on news, right? Wrong. Chris Galizio argues that the ecosystem of capitalism is fundamentally broken because it has transitioned into a world of passive and quant investing. In this Orwellian market, prices aren't set by humans weighing the value of a company or a metal. They are set by algorithms that have no morals and no logic beyond the code they run on. This is why we see the dog that didn't bark. Even with massive geopolitical tension, like the Strait of Hormuz facing potential closure, the markets barely flinch. Why? Because machines don't feel fear. They only follow liquidity. And right now, that liquidity is flowing into zombie corporations and tech giants, leaving real physical assets like silver in the dust. Now let's talk about the golden metric that silver bugs always point to, the gold-to-silver ratio. Historically, for hundreds of years, this ratio sat at about 15 to 1. That means it took 15 ounces of silver to buy 1 ounce of gold. Even in the early 20th century, a ratio of 30 or 40 to 1 was considered high. But today, we are looking at a ratio that has frequently hovered around 80 to 1, and at times it has even exploded past 100 to 1. Let that sink in for a moment. To a value investor, this isn't just a gap, it's a Grand Canyon of mispricing. If gold is the sun of the monetary system, silver is its moon. They are supposed to move in tandem, yet the gap between them has reached levels that historically only occurred during total systemic collapses or world wars, such as in 1939. The logic from the original video is simple. If the system is broken and the machines are ignoring the reality of debt and inflation, then the gold-to-silver ratio is a ticking bomb. When the faith in fiat currency finally snaps, what Galizio calls the Suez moment for the US dollar, the rush back into real assets will be so violent that silver won't just rise, it will catapult to close that 80 to 1 gap. The experts call it the greatest sale in human history. They see a world where Intel makes more money selling its own shares than its actual chips, proving that the financial matrix has lost touch with the physical world. In their eyes, buying silver at 80 to 1 is like buying a ticket to the only lifeboat on the Titanic, while everyone else is busy arguing about the quality of the deck chairs. It sounds like a perfect, bulletproof thesis. The system is fake, the machines are crazy, and silver is the ultimate insurance policy.
But if the math is so obvious, why hasn't it happened yet? If the ratio is so wrong, why has it stayed wrong for a decade? Is the market truly broken, or are we missing a critical piece of the puzzle that makes silver far more dangerous than gold? Because, as we're about to see in the next section, silver has a secret identity that can either make you a fortune or leave you stranded in a liquidity trap for another 20 years. Let's look at why silver is a double-edged sword. But here's the point where most people get blinded by the shine. Silver isn't just money, it's a raw industrial material. And in an economy that is crumbling, as Chris Galizio describes, will manufacturing demand be strong enough to keep silver flying high? You see, silver is a hybrid metal. It's the Clark Kent of commodities. Half of the time, it wants to be a monetary store of value like gold, but the other half, it's a workhorse for industry. In fact, over 50% of global silver demand comes from industrial applications, solar panels, electric vehicles, and high-end semiconductors for the very AI revolution everyone is talking about. This is the double-edged sword that the hype train often ignores. When you buy gold, you're betting on fear. When you buy copper, you're betting on growth. But when you buy silver, you're caught in the middle. If we enter a severe global recession, the kind of financial collapse mentioned in our opening, industrial demand for silver could theoretically crater. Factories slow down, tech production stalls. If the world stops building solar farms, that 50% of demand vanishes. In that scenario, silver doesn't act like a lifeboat, it acts like an anchor. It gets dragged down by its industrial identity while gold is soaring toward the moon. This is exactly why that undervaluation has lasted so long. The market isn't just broken or manipulated by machines, it's pricing in a massive risk. It's asking, is silver a currency for the collapse or a commodity for a dying industrial age? Think about the Orwellian society Galizio warned us about. He says the ecosystem is hollow, driven by passive indices. Well, these passive indices treat silver as an industrial commodity first and money second. They lump it in with oil, timber, and iron ore. When the machines see a recession coming, they sell commodities. They don't stop to ask if silver is undervalued, they just hit the sell button because the industrial data looks weak. This creates the liquidity trap. You buy in because it's cheap compared to gold, but you realize you're stuck in a room where the door only opens if the economy is booming, yet you bought it because you thought the economy was dying. It's a psychological paradox that breaks most retail investors. They watch gold hit new highs while silver sits in the mud, weighted down by its own industrial utility. You start to feel like you're holding a liability instead of an asset. You start to experience decision fatigue. Is the expert right? Is the ratio going to close? Or are you just holding on to a metal that the modern world is learning to use less of? However, don't throw away your silver bars just yet, because there is a tipping point. There is a specific moment when the industrial weight falls away and the monetary soul of silver takes over. It's the moment when the fear factor becomes so overwhelming that it doesn't matter how many solar panels are being built. When does that happen? And how do you know if we are at that point today or if you're about to be trapped for another 10 years? To find out, we need to look at the physical reality check and a test that determines if your portfolio can actually survive a systemic reset. Let's talk about the suitcase test and the final tipping point. So, if silver is weighed down by its industrial identity, when does the anchor finally become a balloon? When does it stop being just a metal and start being the only exit? That moment is called the tipping point. It's the second when the monetary panic, the desperate need to protect what's left of your wealth, overwhelms the industrial data. In 1939, as war clouds gathered over Europe, central banks weren't looking at industrial silver demand. They were buying gold to flee a dying system. But once the public realized the currency was failing, they turned to the only thing they could afford: silver. The ratio collapsed and silver skyrocketed. Today, we are facing a similar physical reality check. Consider the AI revolution. Everyone is buying NVIDIA, Microsoft, and Intel. But as Galizio pointed out, these companies are trading at insane multiples, sometimes 600 times earnings. They are digital ghosts. Now, look at the physical infrastructure required to run them. Every AI data center, every high-speed circuit, every advanced transformer needs silver. The Silver Institute reported in 2026 that we are seeing a structural deficit that simply can't be fixed by printing more paper dollars. You can print $1 trillion in a second, but you can't print 10 million ounces of silver from a mine that hasn't been built yet.
This leads us to what we call the suitcase test. Imagine the Suez moment for the dollar actually happens. High interest rates have broken the back of the bond market. The banks are shaking. You decide you need to get your wealth out of the digital matrix and into something you can hold. You have a suitcase. If you fill it with gold, you can carry millions of dollars of value in a single hand. It is dense, it is efficient, it is the king of value density. But if you try to do the same with silver at today's 80-to-1 ratio, you're going to need a truck, not a suitcase. At current prices, $1 million in silver weighs roughly 1.5 tons. That is the physical liability of silver. It is hard to store, hard to move, and hard to hide in a crisis. This is why silver is often called the poor man's gold. But here's the twist. In a total systemic reset, being hard to move is exactly what makes it a coiled spring. Because silver is so bulky and so rare in its pure, refined form, when the panic hits, the physical premium explodes. You won't be buying silver at the paper price shown on your screen. You'll be buying it at whatever the person holding the physical bar demands. The tipping point happens when the public realizes that the machines we talked about in Part 1 are trading paper contracts that don't actually exist in the physical world. There are hundreds of paper ounces traded for every 1 ounce of real physical silver sitting in a vault. When those machines try to settle in physical metal and realize the vaults are empty, that is the explosion. So, ask yourself, are you watching the right indicators? Don't just watch the gold to silver ratio on a screen. Watch the real asset flows. Watch the physical premiums at your local coin shop. Watch the energy grid bottlenecks. If the system is truly as broken as the experts say, then the suitcase test tells you 2 things. 1, gold is your shield for mobility. 2, silver is your spear for profit. But you have to be willing to hold that spear while everyone else tells you it's just a rusty industrial relic. The question isn't whether silver is cheap. The question is, do you have the stomach to hold a physical liability until it becomes a global necessity? Because once that tipping point is crossed, there is no going back to the old system. The dollar era ends and the era of real assets begins. But how do you actually prepare for that transition without losing your mind in the process? Let's bring this all together. So where does this leave us? Is silver the ultimate opportunity or a decade-long trap? The truth is, silver being undervalued is a mathematical fact. But in a broken ecosystem run by emotionless machines, fact doesn't always translate to profit on your timeline. To win this game, you need more than just a chart showing a high gold to silver ratio. You need extreme patience and a cold, calculated understanding of economic cycles. Investing in silver right now isn't a get-rich-quick scheme. It is a strategic move against a failing fiat system. If you chase the hype, you'll likely get shaken out by the next industrial dip. But if you hold it as the hard asset it truly is, a spear for profit and a hedge against the digital ghost economy, you are positioning yourself ahead of the inevitable Suez moment of the dollar. Remember, the machines can delay the truth, but they cannot delete the physical reality of scarcity. The supply-demand gap is widening, the AI revolution is hungry for silver, and the debt bubble is only getting bigger. Silver is a ticking bomb, but the real question is, do you have the capital and the stomach to wait until the fuse finally burns out? Or will you let decision fatigue drive you back into the digital matrix right before the explosion? I want to hear from you. What is your silver price prediction for the end of 2026? And in a world of Orwellian finance, what is the one asset you trust to protect your family's future? Drop your thoughts in the comments below. I read every single one. If this deep dive helped you see through the noise, hit that like button and subscribe for more surgical breakdowns of the global markets. Stay sharp, stay physical, and I'll see you in the next one.